two most famous people to come from Woodland, Alabama, the great late Vern Gosdin and my wife, Beth Gaines. Y'all, Vern Gosdin, if y'all not familiar with his music, you need to look it up because it is really, really, really good. Let's see. We had some comments in my, here, last night. So someone said the Rick trade is not protected. If SPX goes below your put spread, you will lose 2,000 and your hedge won't start working. So I was at the ball field and I said, I respectfully disagree. I apologize, but I'm on mobile toss at my kids' baseball practice, but it shows that if the SPX breaches my entire put spread, the 5 long puts that I have will pop in value by over $1,000, not counting any resulting increase in volatility, which would make them swell even larger. Is it a perfect hedge for the Rick trade? No, but it certainly provides enough protection for a trade that has a 95% probability of success, even without the hedge. Aha! So we got some debate. And so what we should do is look at it. All right, so the markets are up. We're above the 15-minute opening range. I don't know why this thing resets every time. And if y'all hear that chirping in the background, trust me, it is not as bad for you as it was for me at 3 o'clock in the morning. What it is it's my smoke alarm. And who the fool was that designed a house from 1860 with a battery operated smoke alarm in a 20-foot high ceiling or whatever it is in here. Unbelievable. So I ain't getting on no ladder and breaking my neck and changing it. So I'm gonna have to get one of my kids to do it or pay it. So I'll catch them if they fall. But at 3 o'clock in the morning, there it goes again. That thing's, can y'all hear it? That thing started chirping. And I'm like, I'd be slammed asleep thinking that I was in Las Vegas, playing the slots. And all of a sudden, I thought I was being attacked by a chicken or something. It's just horrible. All right. So we're right at the top of our opening 15-minute range. We're just above the cash open. Looks like this is what we would call an inside day. Not doing much of anything. We're above the hourly mid. We're above VWAP. We're above the bottom of the opening 15-minute range. We're above the overnight low. Where is the overnight high? There it is. So we're being boxed in by the overnight low and the overnight high. Quit beeping! And I just let my dogs out, and they're going to be wanting me in. The best's not here. And it's just one of those days. But the AD is going up. AD is pretty strong at 208 for this to be kind of a inside Friday type day. We'll see how the traders go into the weekend. A lot of times, going into the weekend, that's when everybody fears that everything's going to happen with Putin and Putin's going to do this and Putin's going to, who knows? So let's go to our little thing here. Well, I'll be darned. Our high was at the value area high, right? Value area low, and the yeah, I figured y'all could hear that. I apologize. So we're going to chirp every 30 seconds for our time again. All right. So we're fairly priced. Everything's fine. Everything's working fine, right? We expect to be in this area. We will probably over the next coming days, touch the 50% line, and we'll see what we do. So this is kind of, neutral to bullish in our upcoming couple of days. And, we always draw this little probability. What is that thing called? A probability, whatever that thing is. Here's where price should be in the next upcoming days. Matter of fact, I know there's some of y'all that have signed up with Don Kaufman and his group, which is, I highly recommend it. It's really good. I learned a lot of stuff from that group. So I think I have the SPX expected move, which was a Don Kaufman chart. And he shares it with everybody, so I don't think there's any problem me sharing it with y'all if y'all want it. Let's see, SPX expected move. See what it looks like. That ain't it. That ain't it. looks like I've got a, what's expected move? Here it is, expected move. This is it. Aha, look at that. So what this does is it works on SPX. It's so cool that it gives you the expected moves automatically, right? Based on the volatility and all the pricing and the options. So as you see, our expected move for this 1, 2, 3, 4, 5 trading days was between here and here. And guess what? Looks like the expected move turned out just right. So this is helpful if you're doing strangles and other types of trades, or, you know, rig trades even. And you see most of the time, we appear to be within those expected moves, but then every now and then we have these outlier events like here, but it ended up being an expected move. And so increased volatility means the expected move is wider, blah, blah, blah. Would y'all like this chart? Who wants this chart? Share the grid. Share the grid, baby. All right, I'm pasting it in the chat. Boom. So everybody's got it. Beautiful. All right. So everybody's got the chart. Let's see. Let's go back. And I think I had the expected move cone, right? That's kind of what I was telling you now. Expected move cone. Look at there. That's what we're talking about. I mean, that's generally what it does, right? Is, you know, we have these little expected move cones. And, you know, the further out time you go, of course, the larger the expected move. And there's a measure of implied volatility. Y'all want that? I don't use it a lot, but you're welcome to it. Share this grid. Y'all want that? Beep. Yeah, can you imagine at 3 in the morning and that thing going off all the time? I told Beth, I said, Beth, climb the ladder, turn it off. She said, I ain't climbing the ladder. Listen, I'm not getting up. I've got neuropathy in my, I can't feel my feet. I'm not going up on a ladder and breaking my neck. I mean, come on, Beth. I've got at least $25,000 of burial insurance on Beth, so she can, I'll get my son to do it. He'll be fine. All right, where was I? What are we doing now? Oh, let's look at our, see if our screwdriver will give us a good reading for the day. Come on, screwdriver. Give us a number. Let's see if I remember where there it is. Screwdriver. Where do you get this thing closed? Unbelievable. Come on, you stupid little thing. How did I get it closed? There. All right, let's see if we get a screwdriver for the day. Come on, work today, baby. Yeah, it looks like it's working. All right, which day are we going to? 28 days? 422. Looks like they're where I'm at. Oh, y'all, we're coming back down. Look at this. We're at 72 now. Oh, behave. So we went from 77 to, what did I say, 72? If that's not right, y'all correct me. My short-term memory is all but gone. 3, 25. So we're starting to normalize after an extended period, and I do mean extended period of volatility and uncertainty. So now things are starting to calm down. And as SPX continues to go sideways or slightly up, we should see this come back and normalize. Remember, problem with this is you just don't know when, because we can stay way out here for a long, long, long time before we start to normalize. All right, good. We got our little skew. We got all that. So let's go to the Analyze tab, and let's look at what we were talking about yesterday with that one particular trade. If I can remember which count's got the end. No, it's not that. It's this one. So let's go to the Analyze tab, and let's look at our SPX positions. SPX, and what's my price slices? There we go, baby. I like my processes just like this. Up 5, up 10, up 15. Down 5, down 12, and down 20. That's how I like it. All right, so then we go hide simulations, and we just want to show our positions, okay? So what does this show? Okay, this is why we said, is the Rick trade a riskless trade? So with my positions, let's make sure we got all three of my positions on. I have a Rick trade and I have 5 long puts. Okay, so what happens if the market goes down 5%? I make $1,995. What happens if it goes down 12%? I make $5,000. What happens if we get a 20% move down? Well, we get $13,000. But again, that doesn't take into effect volatility. So that's why we go up here and we go, let's put our volatility in here. And based on volatility now, I normally change that to 15%. I'm going to keep it 10 because I believe if we go down 20%, volatility will be at 62%. Now, there will be those of you looking on thing that says, wait a minute, this isn't VIX, Bobby. This isn't a VIX of 62. I got it. It's just, I've been playing for this thing for a number of years. It's just kind of my gut. I think the volatility will be around 62 if we go down 20% because volatility is elevated. A lot of times I go up 15%, right? And I think it would be up 82. I don't think that. Now I'm adjusting it downward a little bit. So what happens in the event that we go down 20%? We're not going to be up $13,000. We're going to be up $89,000. Oh, behave. All right. Now, again, these are models. You know, I mean, anything can happen. It may not, if volatility doesn't increase to the 62%, maybe we're only have volatility of that. So we're only up, 67,000. Okay. So now let's look at it a little differently. Let's go and let's do expirations. Let's do 2 expirations. Now, this doesn't have any volatility in it, right? So what does this say? If we go down to this number, 20% down, then if it happened today, we'd be up $13,000. If it happened on the 26th, we'd be up $12,000. And for some reason, if it says if it happened on July the 1st, we'd be down $3,200. So let's just look at where our strikes are. Where are our strikes in the old Rick trade here? All right, here's the old Rick trade, right? So the Rick trade would be a max loser where? Yep, that's exactly what we're about to do, Dwayne. We're about to show the strike. Where would the Rick trade be a full loser? Let's make sure everybody knows that. Rick trade would be a full loser if what happens? Well, y'all mad at me starting late? It's probably because I took my mama out for lunch today, and my mama, we went to the drugstore. That's what old people do.
If it breaks your 43.30.
Yeah, right. So if we go past the 43.30,
At expiration.
Yeah, then I'm at max loss on the Rick trade. So let's do a price slice at 43.30. 43.30. So here, 43.30. It's 43.30. See if I just change it. 43.30. So there's 43.30. So let's look and see what we would be doing there. So it says, though, with all of my little things, well, let's just do the Rick trade first. And let me do, I don't want to get rid of those. We'll just leave those others. Everybody remember where the 43.30 is, right there. All right. So let's take and only look at the Rick trade. Rick trade at 43.30. Here we go. Rick trade at 43.30. You're down, let me change my dates, 326, 325, this is 325, there we go. So let's go and see what 43.30 looks like. So 43.30 at expiration should basically be what? That I've lost all my marbles, right? So let's see that, 326 is today, so it says I'd be down 1761. All right. So let's just isolate our 5 loans. What happens to our 5 loans if we go down to 530, all right? So if we go down to, of course, we don't care about the 7122 at this point, but if we go down to the 325 at this point, then we're down 932, or we're up $932. Now do you see why it's a hedge? Now keep in mind, this is without any increase in volatility. It's just standard, hey, if we go down there, then we're up $931. All right. What if we do our little volatility stuff, right? And if we got that big of a jump, where theoretically would my money be coming from? So, if we are at volatility of 22%, it's up $878. If it's 32%, it's up $7,520. If it's up 42%, it's up 17,000. Now, I don't think that the volatility would be that if we go down to the 43.30 today, but at some point, I would think that we would be within a profit of 879 and whatever that would be. That's why I was saying that it's a hedge. Now, do we know specifically how it's going to perform and how volatility is going to pop that up? No, we don't. But we do know that we have a max loss in the RIC trade, which is a defined risk trade, right? We cannot lose more than $2,000 less the credit that we took in on the trade. So I forget what we took in, but let's say we took in $1 and the RIC trade's 20 points wide. You could lose 2,000 less the $100 in credit. So your maximum loss is 1,900. We're saying that this little puppy with no volatility these 5 loans would be up, let's say, $863 or so. It was 900 a while ago. That's with zero rise in volatility. If volatility pops up, so will it all take away all of our risk? Not entirely, maybe, but it possibly could. It depends on how the volatility pops up with that. So what percentage of a down move is that? I'd love to know. So 43.30. What kind of down move is that percentage wise? I mean, I could figure it out, but you see why we're saying that it's a partial hedge. Now, you'll also notice that I did something, a risk-free RIC trade, and I put a question mark. So the question mark is not saying that it is definitely a risk-free RIC trade, but it could be. Could be. So just make sure everybody, yeah, Dwayne, that's exactly right. I've got a buffer on that makes me a tremendous amount of money with a 20% drop that I need to finance some way. And the goal was to wait till we have a huge down day, which we very well may could, and then sell 3 puts that would fully finance the purchase of the 5. If I can't do that, then I need to whittle away using the RIC trade to finance my insurance. That's exactly it. Now, could you figure out a better way to do it? Maybe, to try to finance it, right? But, that's just something that kind of come to me this week. I'm like, well, if I've got those 5 on, which was a great day to buy them because the market had been up, 5 days in a row? Let's look at it. Let's go over here. Let's go to SPX. Yeah, here's SPX, right? I mean, up, sideways, up, down, up. So I bought this thing when in here, right? I bought those 5 somewhere in here when this thing had a massive run up. The best time, you remember our little chart, to buy a put is on up days. Well, how about after 5 or 6 up days? It's even better time to buy your insurance, especially if you go, we're in a bear market. We believe that the market will top out right about here. And then we're going to start to come back down into the downward facing leaning regression channel, linear regression channel. I think it was good pot odds. Then we'll sell some RIC trades to help finance that. If the RIC trade loses money and our strike is breached, what do? We'll roll it out, collect additional credit. That's all we're trying to do. That's all we're trying to do. Questions on that at all? And remember, we don't ever want to buy something unless we can sell something to finance it. So, you love when we've got a little graph that looks like this, to where you go, man, if we go down 20%, I'm going to make $87,000 on a $100,000 account. Those happen every now and then. You can be the worst trader in the world, which I am, and every now and then, because y'all see all the mistakes I make. I don't hide them. I don't hide anything. I make mistake after mistake after mistake. But every now and then, the old blind squirrel gets lucky on one of these little hedge trades. Every now and then, not often, but when it works out good. It really does. So let me fix my little price slice back. There we go. Now we got everything. So a 43.30 is a little less than a 5% move. Let's look at our SPX trade and see how safe our Rick trade is today. Where's my little Rick trade? Little Rick trade, come here, baby. Y'all, I got ball games this weekend. I got 3 ball games tomorrow with 3 kids in 3 different locations. How am I going to do it? I'm not exactly sure. I got 2 of my older kids going on a local mission trip with the church. And that should be interesting. Got to have them at the church here in a little bit. And it's just a busy weekend. Hope y'all got a great weekend planned. Look at this, y'all. I mean, this is money now, isn't it? I mean, the Rick trade is awesome. I mean, I got virtually 0 chance unless, Biden, has a stroke or something of this thing being breached today. Look at that, 0.14 probability of being in the money. 0 delta. Isn't that cool? And how much did I collect for that thing? Let's see, I paid out. I collected $298. Now, one of y'all had a question. Bobby, how'd you get $298 for that? I don't know. It's just when I put it on. When did I put it on? I put this trade on the 23rd, which was Wednesday, 15 minutes before the market closed. And I got $298 for that. So $298 for that, plus I paid $1.93 for that. So I brought in $105. Now, you got to bring in a lot of $105, don't you, to pay for something that cost $3,004? 3,000. The insurance cost me. My insurance cost me how much? My insurance cost me $680 times 5. I think it was $3,400. Down $650. That's bad. But it's still insurance. I still got it on for 97 days. So what I started thinking is this. Okay, Jim, you got a question here. So does the BSH pick up the risk on the 111, 112 in your account? Absolutely. I'm wanting to figure out how to start putting on the 111s, but with extended protection. Exactly. It's exactly what it does. Right? So today the market's up and we've had a continuous up day. So let's say you guys want to just buy tranche outright. You don't want to have to worry about financing your shorts and doing all that. Here's what you do. Right? Let's do it. This is how I made big money in 2020. And by this time, you're probably doubting that I made big money in 2020. I promise it happened. I don't know exactly. I mean, I tried to pull up the old trades and to show y'all I'm having trouble doing that. But, you shouldn't trust me. Your first opinion of me should be, who the heck is this? Right? Who is this guy that has no idea what he's doing? That's what your assumption should be. You should all be skeptical. Every one of them. Don't trust a single thing that I say because I often make mistakes. I just do. And am I the world's greatest trader? No. I am closer to the world's worst trader, but I ain't as bad as I used to be. I used to be terrible. So every now and then I hit home runs and a little bit of singles here and there. And occasionally we lose money and, you see it all play out in real time. All right. So if I wanted to do, well, I may just put on one today. Let's see how this looks. Now, do I want to do it in the SPX or do I want to do it in the E-minis? It's a good question. Let's see. I got $100,000 in this account. Let's see what we could do. We'll just kind of build it out for you. Let's see what it looks like. So where we want to go? Right, you want to go to something that you can sell for $3, and you want to make sure that you got 50 wide strikes, right? So here it is. Here's 67 days, right? So you could sell 3 of the 2600s, right? Sell 3 of those. How much buying power is that going to take me? A bunch. bunch. $29,000 in buying power. All right. So let's look at that. And then let's go and figure out what we could do. So on this, think of it this way. I'm bringing in, everybody remember this, I'm bringing in $896 on the sale of 3 of those options. All right, let's remember that number. 896, 896, Bob. So that's the credit. So now I've got 896 that we can go shopping. We can go down to the Dollar General and I mean, we can just put on some money, right? So what would I then do? Then I would say, what if I went in about 30 days and spent for a 67, so we want to go back to 37, around in here, and buy me some insurance. How much do I have to pay? I have $867 or $896 to spend. So let's go spend us some money. All right. So 5 times 2, that'd be 1,000. 5 times that, it's 5 times 850. That looks like the one I need to buy, doesn't it? So I could go and buy 5 of these, right? 1, 2, 3, 4, 5. So what we have done is we have diagonalized, you see, because they're in different expirations in different strikes. Now, I would call this calendarized if we sold 3 and bought 5 of the same strike, but I'm able to get my longs a lot closer. And I get to do this for a $95 credit. Still says it's got a $29,000 worth of buying power fit. That's why I would probably do this in the E-minis, right? I just like the span margin. Just know what you're getting with span margin. Span margin can go crazy in the event of a apocalyptic drop. Sometimes does. But when you got our hedges on, you don't care because you are rolling into money and you go into Applebee's on a date night. All right. So let's analyze our trade, shall we? Kind of cool when you can do an insurance trade for a credit. Right? So let's close this puppy down and let's look at SPX. And we're going to go hide our positions so we only see our little shimmy-big. Take that off. Uh-oh, something else is hiding out here. Oh, there it is. It goes flat. You want to make sure that's the only thing you're analyzing is that one trade. All right, so let's look at this little trade. All right, so this little trade says if we go down 5, we're going to make $369. If we go down 12%, we're going to make $2,300. If we go down 20%, we're going to make $10,000. Yay! Not bad on a trade that we put on for a $100 credit. All right, so why don't you and I now look at the vol? If vol pops up, what are we going to make if we go down 5, 12, and 20? Remember, my thing is most of the time, I like to stress my stuff at the 20. I want to see what happens in the event we get a 1987 crash, which was 24%, or we get the Corona crash, which was 35%, although the 35% drop was not all in one day. But I'm looking for that, man, that one-day payday. And you see, for a trade that I put on for $100 credit, they're paying me, y'all, to put it on. And the market goes to crap. I make $31,000. Y'all see it on the left over there. Yeah, make sure you know where you're looking at. I'm gonna make $31,000. Are you kidding me? That's a no-brainer. Now, what do you do to manage risk? You got to take off that short put when? By the time it gets to 21 days or so, you don't want the gamma risk of that short put, and by that time, your long put will have been expired. So what you're going to do if you enter in a diagonal version, if you enter into this diagonal version, you got to watch it a little bit because you're going to have to put on another one at some point. I much prefer to have my short puts and my long puts in the same expiration. But this is a cool way to do it. And this is the way that I did it in March and February of 2020. When it's the only time that my body ever shook while I was taking off trades. My gosh, $780 million, $780,000 of buying power. I don't think that's right. Don't think that's right. If it is, I shouldn't put that trade on. That's a lot of buying power. All right, questions on that? Yeah, and so this is exactly what you're doing. You're using this to hedge your 111s and all those other trades, right? So let's now go. I'm thinking I may route that puppy. Kind of like that, right? But let's hide our simulations. Let's just show our positions, just see how we're doing. So now make sure we got everything marked. And then you want to go over here and you want to go, instead of single symbol, you want to go to portfolio weighted, right? There you go. So it looks a little rough, right? That's where you see valleys of death and blah, blah, blah. But for a 20% down move, how are we looking? We're looking at, with 4 vol steps up then, you're still up, $6,000 or so, which ain't bad. Now, what if we do everything? Show all, baby. Let's put that trade on that we got here. We just look at there. We just killed the valley of death. Let's show that again. So now 20% down in the market, sudden thing. Now we're up 48,000. Should I put on? Here's the question: should I put on that hedge that I just created today? Yeah. Right. I should. With all these 111s and everything, yes. Let's take it without the. Now, watch this valley of death. I don't have a valley of death. Valley of death is gone. Watch this. High simulations. Oh, Bob may have a potential valley of death. Right. How do you get rid of it? You put on a new hedge. Just go on. Ta-da. Now, let me just make sure that. Wait a minute. Oh, it's got 2 hedges on there. So let's delete this one in the E-minis. That's another thing. You got to make sure you don't have too many of these simulated trees. Now then, how we're looking. Still eliminated the valley of death. Now we're up 36,000. Ta-da! Y'all, that's hedging. That's hedging. And so now, at the end of the day, hey, baby, I'm going to put me on another rig trade because I'm hedged. Now, is it the perfect hedge when you lose 2,000 in a day? Does that mean I have to close some of my insurance to pay for that? Yeah, maybe. But when you're putting on a trade that has a 95% probability of success anyway, I mean, rock and roll, baby. Put that trade on. You've got no fear. So that makes sense. I was wondering why you were leaving the risk cliff out there. Yeah, makes sense, right? It makes sense for me to now go in and put on that trade today. Now, I'll probably do it in the E-minis because of the buying power. Let's see what the buying power in the E-minis, see if we can do this again. So we'll do 2,600, see if we can recreate this trade. And that, I'm telling you, that's the only trade I had on in January, February of 2020. I had the diagonal Black Swan hit. That all I had. And I had a ton of them. I had a ton of them. And little Bobby, we went to the old Charlie's that night. So I like going out more than 60 days, right, for my shorts. So what do we say? The 2,600s? Here we go. We'll sell 3 of them. Or heck, you don't play ball? 12 of them. Depends on how big your account is and what you can stomach, right? So if we do that, then we're going to bring in 3. So that would be what? 3,600, 1,800 and $26. How does Daddy do it in his head? Because I've been doing it a long time. So we bring in $1,800. So now you got $1,800 to spend. All right. So let's go out, go in about 30 days. So 67, so we go back to 37. And we're going to go spend $1,800. So how would I do 3,600? So I do 20 times what? Oh, I'm losing my numbers now. I can't do math in my head. 20 times 3 would be 3,600, right? But these are E-mini, so they're in half. So we could go out here to the 3330. Let's see, what we could do, 3330, and we'll do 20 of them puppies. I like doing this. I could just type in 20, but I like doing this. I like clicking. I like seeing it. Okay, 20 of those. Boom, baby, boom. So that's going to cost me a debit. Ain't no problem. We'll just go on down. 3220, 3200. That's still a debit. I got my numbers so mixed up. I try to do too much things in my head. Well, if you go, there you go. So say we wanted $1 credit. And see, the cool thing is my loans are higher than my shorts. I like that. There we go. $1.20 credit. So you're getting 60 cents per whatever tranche. And we got 4 tranches here, right? So you'd be pulling in $240 minus the commissions. That's the only problem with the futures. You got some commissions here, but you're doing the overall trade for a credit. Buying power effect is 0. I love it. All right, let's analyze the trade, see if this does what it's supposed to do. Analyze trade. Analyze trade. All right, here we go. Yes. So now we're going to go hide positions so that we got, you want to make sure you only got this one trade in here, the 1220, but something else is still in there. Aha! You devil, you. I see you, SPA. Oh, I got it on portfolio. Wait. Now, got to go to single symbol. Now, trade in. Now, let's see how strong this little puppy works. First of all, let's look at our price slices. Price slices. You fix your price slices any way you want. I got them like I like them. I like them 5, 12, and 20. That's where big old daddy is happy. That's how I stress. All right. So now I'm going to be up on a 20% down move. I'm going to be up 20,800 whatever dollars. I like it a lot. All right. Let's see how we're going to look on a 20% move with volatility going up 10%. I would say that we're going to be on this one trade. We're going to be up $63,000. That ain't bad on a $100,000 account. Now, how would this look if we do this with our whole portfolio? Do we have a sea of death or do we take care of it? I don't know with you. I don't see no sea of death to you. So we're up 62,000. Portfolio beta weighted. I like it. Big Daddy likes it. Liking it a lot. So now you see the power. This is the diagonal version of the Sweet Bobby Hedge. Okay. Is it my favorite version? Unfortunately, it's not. I like having my longs and my shorts in the same expression. If I can't do that, then I'll put them in diagonally. Now, what are you going to do? So here's what the easiest way to do it is if your longs expire, all right, you probably need to put some more longs on. So let's think about it. Where would I put my longs on, my new longs? Okay. I would put my new longs. Now, y'all don't tell anybody this, okay? This is secret sauce stuff. We don't talk about this. First rule of Fight Club is nobody speaks about Fight Club. First rule of the Sweet Bobby Hedge is nobody speaks about Fight Club. Here's what I would do. After these 20 expire, I would go in and I would buy longs under my shorts at the 25.50. Gosh. And then what would I do? Then I would go out another 30 days and I would sell 12 to pay for my 20. And I just keep it going. Isn't that cool? Everybody with me? What happens in 35 days when these loans expire? Well, I don't want to just leave my shorts out there. So I would buy 20 below the my existing shorts, and I'd probably do that at the 25.50. Or heck, I could even buy them closer to the money above my 2,600 strike, and then go out another 30 days in time and finance them with the sale of 12 puts, so that the overall trade is put on for a, say it with me, credit. Y'all, is that not powerful? Everybody got that. And that is a sweet little deal. So we're putting on our insurance with our RIC trade. And we're doing all this so that, you know, I mean, I like this trade a lot. Let's put it on. Let's put it on there, Bobby old pal. Can I do this trade? There's one trade, or what? They give me a error. Hey, it might let me do it. It might just let me do it. It's working, baby. I think it's working. I may just let her stew a minute, see if we can get her filled. If it doesn't, I'll come in at the end of the day. Take my credit for my insurance. So if we do it this way, y'all, is it possible that, hey, you got to keep an eye on it. When your longs expire, you don't leave those shorts, your 12 shorts, unprotected, right? You don't leave those unprotected. So what do? You buy another 20 longs and you sell another 12 shorts to pay for it. Oh my gosh, we've got royalty in the house. I didn't know Rick was here. Rick, we're messing with your trade all over the place. Rick, how you doing?
Doing fine, and you're doing a great job. I love it.
Thank you, Rick. So, you know, is the insurance we have for the Rick trade, is it perfect? No, but it helps. Helps, certainly. So one of the things that I thought about is using the Analyze tab to collect the greater credit for the Rick trade, right? And, you know, running it on the Analyze tab so that you kind of work out, hey, how my longs, how would that help out the Rick trade? So that what is my profit on my, if we go down past the short, right? And you kind of work it out where you go, okay, I can make it where the Rick trade is a break even if we, you know, go down that amount. So that's the cool thing, is you can use the Analyze tab to kind of get that thing, you know, worked out. So you may be saying, instead of $2,000, you know, instead of collecting the credit of 35 or 40 cents, if you've got hedges, adequate hedges there, go to the Analyze tab and play with it. You may be able to collect a credit of $300 on a 20-point wide spread, or 400 or 500, do a 50-50 trade, so that even if it does go, you know, there, that you're fully protected. Use the Analyze tab. The Analyze tab is very, very powerful. And I didn't realize it until Karen herself said she camps out on the Analyze tab. So if it's good enough for Karen, it's good enough for us. All right. All right. Great session, y'all. So y'all go put your 111s on, go put your hedges on, and I will see y'all Monday.